Hello again and welcome back to London. The timing of the Fed rate hike is a known unknown, but do we now know more about that known unknown? Well, I've been speaking to David Starkey from Cambridge Global Payments. There's lots of interesting aspects to the Fed at the moment. It now seems that the market is moving in hers and it's looking at a September hike maybe. I'm just wondering, how much better is the US economy going to be in September than it is now?
Certainly has the September liftoff date priced into the market. That's the general consensus. The reality is, I don't think that you need to see the US economy get markedly better in the sense of its rates of growth, but rather keep on the trajectory that it is right now. And if Yellen has the comfort of knowing that there's been that much growth and that's materialized, then she'll be in a place where she's comfortable to hike interest rates.
Yeah, what about the inflation picture? Because there's lots of emphasis on jobs and on growth, but the inflation picture, the rate is nowhere near their target at the moment.
Certainly, for the actual headline number, it is below target, there's no question about that. But the concern is that as the cycle period for inflation measurement moves past when energy prices declined in the back end of 2014, inflation measurements will quickly accelerate, and the Fed wants to be ahead of the curve on that rather than chasing it.
Yeah, well, what about the headwinds? Everyone's very quick to point out to the drastically improved unemployment rate, for example, but there are certainly headwinds there, especially in terms of the quality of employment. There's lots of part-time labour, and also many people have fallen off the radar in terms of those statistics.
Certainly, and that's just the domestic factors. There's external factors as well, but in terms of the base case, what the underlying picture is there's optimism, and that the extremely loose monetary policy and accommodative measures that were put in place during the financial crisis might not be the appropriate way forward, and that not suggesting that we're moving quickly back to historical 2% and 3% benchmark rates, but that we can move higher off of zero effectively. So
what's your call on the Fed then? When do you expect to see the rate hike, and how would it look progressively after that?
I think you're going to see a first rate hike. I'm with the consensus, September, perhaps a little bit later into the autumn and winter, but that'll be very dependent on data. But again, September consensus seems to be on the mark for the moment. Yellen's been very clear. It's going to be slow and gradual. So rate hike, wait 3 or 4 months, assess whether it's appropriate to hike rates again. And the kinds of rate hikes that we're going to be looking at are going to be 0.25%, not 0.5%, and certainly not the 1% that we saw when Bernanke cut the rate 1% back in the financial crisis.
Yeah, what does this mean for the currencies? I hear the phones are very busy behind us. What are the currency implications of all of this?
Certainly lots of volatility. Uncertainty breeds volatility. We're seeing US dollar come under a little bit of pressure. That feels temporary. Once markets get comfortable with the idea that rate hikes will occur, and likely occur before the Bank of England in the UK, US dollar is going to find itself on its front foot once again, and it'll be heading lower both against the euro and sterling.
Well, how do you think cable looks at the moment? I've been speaking to people over the last couple of days saying it's looking a little bit toppy at the moment. What's your view of it?
It certainly feels toppy. From the charts and from technical factors, it's very much overbought. Momentum indicators suggest that we're looking for a break to the low side, perhaps revisiting the pre-election lows in the low 150s.
Yeah, and just to finish on Greece, because we can't ignore it, what are you telling your clients? How are you managing that risk?
Better to act now when you know what you can do rather than wait. Certainly there's a possibility that Greece manages to fix itself, but that's looking less and less likely with every day that passes. And the risks in the short term are very high. In the long term, Greece perhaps leaving, if contagion can be avoided and Italy and Spain aren't also looking to leave, then there might be an argument for a stronger euro on the back of that. But in the short term, markets discount uncertainty and euro will suffer.
Well, thanks to David for his insight into things. Stay tuned for more interviews and analysis, but from London, goodbye for now.